Retirement is often viewed as a time when your taxes automatically go down. But for many retirees, the opposite happens. One of the most common tax mistakes I see isn't paying too much in taxes. It's failing to understand how different sources of retirement income are taxed in the first place. The truth is that retirement income can come from several different sources, and each may be taxed differently. For example, withdrawals from traditional IRAs and many employer sponsored retirement plans are generally taxable as ordinary income. Some retirees also plan to supplement their retirement with income from rental real estate. While real estate can be an important part of a retirement strategy, its tax treatment is different from other types of investment income and should be evaluated carefully. Understanding how rental income, retirement accounts, withdrawals, and investment income work together is an important part of tax planning. Investment accounts may generate capital gains, qualified dividends, or interest income, each of which may receive different tax treatment under current tax law. When these various income sources are combined, they can affect more than just your income tax bracket. Depending on your circumstances, they may also influence how much of your Social Security benefits become taxable, affect your Medicare premiums, and impact other important tax thresholds. In retirement, it's not just how much income you have that matters, it's where that income comes from. Different income sources are taxed differently, and understanding that distinction can make a difference in your overall retirement plan. The good news is that there are planning opportunities. One example is carefully managing which accounts you withdraw from each year or in what order. Another strategy for some individuals may be considering Roth conversions during years when taxable income is relatively low. Others may want to coordinate withdrawals across taxable, tax deferred, and tax free accounts as part of their long term tax efficiency. The goal isn't necessarily to pay least amount of tax in a single year. Instead, it's to make thoughtful decisions that may help improve your tax efficiency over the course of retirement. The key point is that retirement tax planning isn't something to think about only when you are filed for your tax return. It's an ongoing process that should be reviewed each year as your income, expenses, financial goal, and tax law change. Every person's financial situation is different. The strategies that make sense for one retiree may not be appropriate for another. That's why decisions involving taxes should always be evaluated in the context of your overall financial plan and, when appropriate, in consultation with your tax professional. If you found this video to be helpful, consider subscribing for more educational videos on retirement planning, tax-aware investing, Roth conversion, Social Security, estate planning, and other financial topics. I'm Humphrey Thomas. Thank you for watching and see you in the next video.